If you hold a retirement account with exposure to big technology stocks, you are carrying debt you were never shown. Your fund's holdings report profit margins, cash flow, and balance sheets that look clean, controlled, and conservative. What those numbers do not include is the hundreds of billions of dollars in future obligations that the companies themselves have structured to stay invisible. 5 of the largest technology companies in the world, Amazon, Microsoft, Meta, Alphabet, and Oracle, have committed to $662 billion in data center lease payments that do not appear as debt on their balance sheets. That number is larger than all 5 companies' combined recorded debt. Most investors assume a company's balance sheet shows what it owes. The data shows something else entirely, a structure engineered so the obligation exists in every way that matters, except the one way that gets reported. This is not the first time a company has used a legal structure to keep debt off the page investors actually read. In 2001, Enron collapsed after regulators discovered the company had used off-book entities to hide over $1 billion in debt while reporting record profits to shareholders. The mechanism at the center of this video has a name: off-balance sheet financing. In plain terms, it means a company gets the use of an asset, a building, equipment, an entire data center, without recording the debt used to build it as its own. Picture a keystone at the center of an arch. From outside the building, you see a smooth, finished ceiling. You do not see the single stone bearing the weight of everything above it. The arch stands because of that stone, but nothing about its outward appearance tells you it is there. Here is how the structure actually works, in 3 steps. Step 1. A hyperscaler needs a new data center but does not want the debt used to build it counted against its own balance sheet. Step 2. A separate legal entity, often a special purpose vehicle funded by private capital, borrows the money and builds the facility instead. Step 3. The tech company signs a long-term lease to use the building, agreeing to pay for decades, but because the lease has not yet commenced, accounting rules do not require the obligation to appear as a current liability. One example makes this concrete. Alphabet disclosed in a single quarter that its future lease payments for facilities not yet recorded on its balance sheet jumped from $23.9 billion to $42.6 billion, nearly doubling in 3 months. 90% of that growth came from data centers that do not yet exist on paper as debt, even though the payments are already contractually owed. The business survives the accounting. The risk does not disappear with it. The last time this exact mechanism ran at scale, the entity built to hide the debt was not the story investors were told to watch. The company at the center of that earlier collapse was Enron, based in Houston, Texas, once the 7th largest corporation in America by revenue. Throughout the 1990s, Enron stock climbed because Wall Street believed the company had transformed itself from an energy pipeline operator into an innovative trading firm, generating steady profits no competitor could match. Analysts praised the company's growth. Business magazines called it one of the most admired corporations in the country. The surface narrative was simple. An old industrial company had reinvented itself for a new economy. What was actually happening underneath was a network of special purpose entities created and controlled by Enron's own executives, used to move debt and failing assets off the parent company's balance sheet entirely. These entities borrowed money, in some cases guaranteed by Enron's own stock, and used it to buy Enron's underperforming assets at inflated prices, allowing the parent company to book profits that existed only on paper. Regulators and auditors, including the accounting firm Arthur Andersen, either missed the structure or chose not to flag it. For years, the arrangement worked exactly as designed, invisible to shareholders, reading the reports the company was legally required to file. In October 2001, Enron disclosed a third-quarter loss of $618 million and a shareholder equity reduction of $1.2 billion tied to those same off-book partnerships. 63 days later, the company filed for what was then the largest bankruptcy in American history. Employees who held Enron stock in their retirement accounts lost the majority of their savings. The stock, once worth over $90 a share, fell to under $1. $90 to nothing, 63 days. The parallel is not exact. Enron used its structures partly to disguise outright losses, while today's hyperscalers are financing real, revenue-generating infrastructure, not covering up failure. The structure is not identical, but the mechanism is debt engineered to sit outside the numbers investors are trained to trust until the moment it cannot be hidden any longer. What the historical record does not promise is that this ends the same way. Enron's collapse came from fraud layered on top of an accounting structure. What is happening across the data center build-out right now is, so far, legal, disclosed in footnotes, and defended by the companies using it. That distinction matters, and it is also the reason 4 United States senators sent a letter this year asking regulators to examine how much of this debt the financial system can actually see. Right now, global spending on data centers is projected to reach $7 trillion by the year 2030, financed increasingly through private credit, joint ventures, and special purpose vehicles rather than the company's own balance sheets. Every arch has a keystone. The question the historical record leaves open is what happens to the ceiling when investors finally look up and ask which stone is actually holding the weight. That is not a prediction about a specific date. It is a description of a structure and a reminder that the last group of investors to understand where the weight was sitting were the ones who trusted the balance sheet the longest. The mechanism does not care whether you understand it, it runs either way.